Hi, and good morning, everyone. Thank you so much for joining us. The IIB is thrilled to host this 1-hour webinar with VERMEG. In this program, we will hear from VERMEG regulatory experts, Paul Baik and Paul Benziger. Paul Baik is the Regulatory Enablement Manager at VERMEG. With more than 20 years of experience in the banking and regulatory space, he is responsible for analyzing and assessing changes in regulatory requirements, as well as examining how to respond or to improve current technology. Paul Benziger is the managing consultant for regulatory reporting at VERMEG. With 25 years of financial industry experience and multiple advanced business degrees, he provides clients with regulatory guidance and application support. Today, they will provide their insights on VERMEG's 2023 Senior Loan Officer Survey on bank lending practices. They will discuss banks' tightening standards in terms of for C&I loans, the weaker demand for these loans, and much more. We would like to make today's session as interactive as possible, so please submit your questions throughout the program using the Q&A feature located at the bottom of your screen. To both Pauls, before we begin, I want to say thank you so much for joining us today and sharing your knowledge and expertise. We're very excited to hear from you. And thank you very much to VERMEG for their continuing support as an IIB Gold Level member. We are stronger because of your membership. With that, I'll hand it over to Paul Baik to take it away.
Thank you. Hi, my name is Paul Baik. Again, I'm here with my colleague, Paul Benziger, and we're from VERMEG. First, we would like to thank the IIB for providing this opportunity for us to engage with the members, and we thank you, the members, for attending this webinar. We would like to talk to you about the result of the Senior Loan Officer Opinion Survey and share our findings and observations. But before we get into the results, we would like to talk to you about the survey itself and give you the background on how it started, the information it's collecting, and its uses as well. So the Federal Reserve started the survey in 1964. When it began, it was conducted quarterly with 120 respondent banks and consisted of 22 standard questions, mainly seeking information pertaining to bank lending practices. Then in 1984, the number of respondents was reduced by half, the number of core questions reduced to 6. From 1984 to 1987, the authorized frequency increased from 4 to 8 times a year, and again reduced from 8 to 6 times a year. And notably in 1990, the respondent panel was enlarged to include 18 of the largest U.S. branches and agencies of foreign banks. And in 1994, the board increased the number of foreign banks surveyed to 24, which was to make the foreign bank coverage more complete and to rectify underrepresentation of branches of our European banks. And in May 2012, the Federal Reserve reduced the minimum asset size for panel institutions from $3 billion to $2 billion and added 20 domestically chartered commercial banks with assets to $10 billion in total assets to the authorized panel. Currently, this voluntary survey is conducted up to 6 times a year, and the Federal Reserve recommends no change in the frequency of this survey. With respect to the type of information that the survey collects, there are approximately 25 questions that are designed to measure the changes in credit standards. And also there are 2 versions of the survey, one to domestically chartered institutions and one to U.S. branches and agencies of foreign banks. It's important to note for the survey and for the purpose of this webinar today that the survey to the branches and agencies of foreign banks contains fewer questions. Specifically, it omits the questions on residential mortgage and consumer lending because these entities typically do not make loans to households, if at all. In terms of the reporting panel, the Fed uses the statistics from 2017 So for domestically chartered commercial banks, as of March 31st, 2017, the panel of domestic respondents contained 80 banks, 47 of which had assets of $20 billion or more. The assets of the panel banks totaled 11.8 trillion and accounted for about 69% of the 17.0 trillion in total assets of all domestically chartered institutions. For U.S. branches of agencies, the Federal Reserve indicates that it tries to maintain a panel size of 24, which is the authorized size. As of March 2017, the panel included 23 institutions, 21 of which are located in the New York district. In 2017, the CNI loans held by these respondents was 187.7 billion, which is about 68% of all such loans held by similar institutions, which was $274.8 billion. To keep the panel representative with respect to the parent bank's countries of origin going forward, the FBO branches would continue to be added to the panel based on the location of the parent bank as well as the size. And before we move on to the result of the most recent survey, I thought it would serve us well if we could pause and have a short discussion about the survey. So, Paul, what do you think of the survey? Is this a popular metric that the market follows, or the opinions of all respondent banks treated equally?
Yeah, I'll address them in sequential order there, Paul. Thanks for the introduction and the overview. You know, the survey provides information to the Fed for the supply and demand of bank credit. The survey responses are used internally by Federal Reserve staff in monitoring bank lending conditions as an input into research and analysis about broader economic and financial conditions. So staff analysis is published fairly frequently. It appears in Fed publications such as the Teal Book and the Financial Stability Report. But and you'll hear Chair Powell and his predecessors say frequently, it's one data point. So they get a lot of different surveys, they get a lot of different information, they hear a lot of things in internal discussions with banks, and they combine them. They look to see what's similar, what's different, are the different data points similar, consistent. As far as whether it's a popular metric, it tends to be more talked about in times either of crisis or declining demand or increasing demand. So when nothing's changed, when the economy's fairly steady, it's not talked about a lot. So you've seen it's popped up in the press more frequently in the past year since the COVID-related lockdown. Again, Chair Powell, I think yesterday he spoke and he commented that the latest report, and we're talking about October, is broadly consistent with what we see and what we have been thinking about the situation. So again, I think the survey gets looked at more when it's inconsistent with other data factors. As far as your last question you have up there, there's actually two analyses of the survey that go on. One is weighting all the banks the same. So I think you said there were 18 non-FBO banks. They get weighted the same. The individual questions, so if Citi and Chase give their opinion, it's 50-50. there's a second calculation, and in that, the questions are weighted by each bank's lending in any category. So under this weighting scheme, if Chase has 3 times the loans in a certain segment than Citibank, then Chase has more input into whether lending is expected to increase or decrease. The weighted series are frequently referenced in publications such as the Teal Book or the Financial Stability Report. The unweighted surveys are generally what is quoted in the press. So the two different methodologies capture slightly different developments. The unweighted measures of net changes in standards are useful for measuring common trends in banking without allowing any single bank to have undue influence. In contrast, the weighted measures can be useful for capturing who has more influence. If it's commercial real estate lending and a bank is much larger in that, it's giving more emphasis to that bank's anticipations.
Thanks, Paul. No, go ahead.
No, I was just going to say if anyone has any comments to put them in the Q&A, but I'm done.
Yeah, so I'm still, I guess I'm hung up on this notion of survey being responses to questions. And when we discuss this, there are different measures of the responses, and still very curious that survey results are unweighted and weighted by the volume of lending or size of banks. So there are some subtle information that can be gleaned from weighting scheme.
Yes. If a bank is very small in a particular market segment, in one sense, their anticipation of what they're going to do is not as significant than if it was larger. Right? If a bank has $10 million in lending to some segment and it expects to increase 20%, it's just not that relevant. Now, again, in the unweighted, the reason they do both, in the unweighted, it provides a general sense, and it doesn't allow larger banks to be overemphasized. But in the weighted, mathematically, it's probably more relevant to what's going to happen in the economy.
Okay. Thanks. Thanks for that, Paul. And at this point, we would like to present to you the results of the survey conducted in 2023. As we have indicated, there are many more questions, but for our presentation, we have only concentrated on one question and the responses to that one question. So the questions are, the question was, over the past 3 months, how have your bank's credit standards for approving applications for C&I loans or credit lines to large and middle market firms and to small firms changed? Large and middle market firms are defined as those having annual sales of $50 million or more. Additionally, the sample for the survey is selected from among the largest banks in each Federal Reserve District. Here, large banks are defined as those with total domestic assets of $50 billion or more as of September 30, 2022. So as you can see, in January 2023, 55% of all respondents indicated that their lending standards were not changing. This response is essentially the same whether large or small banks. 45% indicated that they were tightening the standards in January. In April, the responses were similar to January, 54% remaining unchanged, while 45% tightening. In July, of all respondents, those that indicated that they were tightening the standards increased to 51%. Here, we should also note that 9% of large banks were tightening considerably. In October, however, 63% respondents indicated that they were not changing the lending standards, while 35% tightened. And first time in 2023, 2% indicated that they were easing the standards somewhat. In terms of the reasons why the banks were tightening the standards, two stood out. Less favorable or more uncertain economic outlook, reduced tolerance for risk, which I suppose means that given the return, the risk is not worth taking, or conversely, given the risk, the return has to be higher. Now we move on to the survey results from U.S. branches of foreign banks.
Well,
The question-
Paul, we had one question, so should I respond
Yes.
to that now?
Yes.
Okay, I'll read the question first. The question was, how are FBOs that have both a branch and a retail subsidiary bank accounted for? Does each entity file separately? No, they don't. It's filed, or the survey is done at the parent level, but the retail subsidiary, if it's primarily doing for FBOs, consumer banking questions aren't asked, those that are specific to consumer banking. So it's probably not going to be included much in the results unless the subsidiary also has general C&I lending. So you can continue, Paul.
Okay. Thanks for that, Paul. All right, so I was about to present to you the survey results of U.S. branches and foreign banks, and in January 2023, so the 67% indicated that they were not changing the standards, and while the 28% tightening. And in this case, the question is the same. Over the past 3 months, how have your bank's credit standards for approving applications for C&I loans or credit lines changed? And also, I should mention the representation. So as of September 30, 2022, the 18 respondents had combined assets of 1.4 trillion compared to 3 trillion of all foreign-related banking institutions in the United States. And the sample is selected from among the largest foreign-related banking institutions in those Federal Reserve districts where such institutions are common. So the results, if I were to contrast the results of January survey, in the same period, domestic banks have responded. 55% of all respondents indicated that their lending standards were not changing, and 45% tightening. In April, 74% indicated that they were remaining with the standards, while the number of respondents tightening shrank to 26%. And in July, the same as more of the same as in April. 79% indicated that they were remaining with the standards, while the number of respondents with tightening standards shrank to 21%. And in Where did October go? Oh. Okay, so I'm missing October. I don't know what happened. In October, it's not shown here, but I'll just report to you. The contrast between the banks that have chosen to remain unchanged versus those that are tightening has become more accentuated, with 90% indicated that they were not changing the standards, while 10% tightening. In terms of the reasons why the banks were tightening the standards, as in domestic banks, the surveyed U.S. branches said less favorable or more uncertain economic outlook and worsening of industry-specific problems, reduced tolerance for risk, and decreased liquidity in the secondary market for these loans. So here, responses B and E are more significant. A greater number of respondents indicated that these are the reasons they're tightening the standards.
Yeah, and I think if I could just interject, that's consistent with what not only the Fed sees in the economy, but what all of us do also see. Standards are tightening, rates are way up, and that decreases demand to an extent, but it also the risk in addition to the pricing caused by the rates. And apart from the Fed survey, there are other surveys. There's something called the Business Leaders Survey Activity, which looks at the New York metropolitan area, and they ask not banks, but the other side, borrowers, what they anticipate. And they anticipate declines in borrowing. And they also ask questions about wage growth, which the most recent survey indicates is going to slow, and a more modest increase in capital investment. And the short-term outlook, again, from the borrower's side, is that they don't expect more improvement.
We also, it looks like we also have a question. You want to address it?
Yes, so the question is, are these results consistent with domestic banks? I think you had a slide on that, Paul, but I'll respond to it now. There's definitely differences. I mean, and to a certain extent, the reason there's two different surveys is the Fed doesn't necessarily expect them to be the same. They're broadly consistent, but there tends to be less movement among foreign banks. So there's less valleys or soaring increases among foreign bank branches. And I think that makes sense to me in that FBOs tend to have a more concentrating lending. It's, you can't speak for every bank, but they're doing C&I lending. They're doing a lot of syndications or participating in big company loans underwritten by domestic banks, but they have less specific lending segments. And I think the smaller the lending segment, the more likely there is to be volatility either way.
Yes, the question is very timely. We're about to comment on that very question that you asked. So thank you for that, Paul. I'm gonna move on to the trend. So the pie chart the pie charts are useful in like seeing the distribution of responses, but to understand what their responses mean in the current condition, we thought it might be useful to look into how they have responded in the past. For that, we thought a chart showing a trend would help us understand how the banks that had responded under various industry-wide conditions. So here is a trend chart from 2019 until now. We chose this period in time because we lived through the pandemic, followed by economic recovery and prolonged period of interest rate hikes. The trend shows that the number of domestic respondents tightened the standards went up in July 2020, arguably in the thick of the pandemic, which then came down a year later. From then, it has been climbing up until recently. The trend is true for lending to large and medium-sized firms as well as those for the small firms. In case you're wondering what reasons the banks cited in easing the standards, these were the reasons that more of them indicated as their key reasons. So more favorable or less uncertain economic outlook, improvement in industry-specific problems, more aggressive competition from other banks or non-bank lenders. For reasons cited from U.S. branches of foreign banks, again, more favorable or less uncertain economic outlook. So there is a similar trend chart for U.S. branches and foreign agencies of foreign bank, but we left it for discussion. So the Fed did not provide the same data for the trend as in domestic banks, so we put it together. And again, the chart, the trend shows how the trend of tightening or easing lending standards from 2019 through 2023. So as you can see, the trend is, I would say, different. And again, why is it different? What exactly are the U.S. branches of foreign banks doing? Are there different factors at play? And whenever I have questions like this, I turn to you, Paul. So what do you think? What's going on?
Yeah, it's similar to the question that was asked, and I think there's more consistency in foreign bank branch lending in the U.S. I mean, they specialize in certain loan segments, and they just, that's their bread and butter, so to say. So they're less affected by economic trends than larger banks, domestic banks that have many product lines and can say that, well, we're involved in forestry lending, for example, and that doesn't look too helpful. Let's just get rid of it. And then the other thing is the size, the size of the foreign branches that are covered by the survey are about 1.5 trillion, whereas the domestic banks, it's 13+ trillion in the last survey. So again, statistically, it's not an apples to apples comparison.
Are the decisions on lending standards for the branches dictated by parent companies' policies or parent country's economy?
Yes, I mean, it depends on the specific organization, but some branches exist primarily to serve the U.S. operations of their parents' clients. in addition, any economic distress at the home office would filter down globally. So there are, you know, banks have credit limits, they have geographical limits, they have industry limits, they have all sorts of limits. And in general, these are set globally by home office and then carved up, or maybe it's more of a bottoms down approach, but they're impacted significantly by what goes on in their home country.
What about demand? How much a factor do you believe a demand for loan is affects lending standards?
Yeah, I mean, demand affects supply, and it's the traditional supply versus demand curve that economics teaches us. If you know what this survey is asking is the expectations of what you will lend, and if demand and banks factor in their demand in answering these questions. So if demand increases, there's two things. If you're below the intersection of supply and demand, then it's going to have an effect on supply. In other words, if you want to, if your limit says you can lend $2 billion and there's only $1 billion in demand, but then demand doubles, you will lend more. However, if you're above the intersection of supply and demand, in other words, you expect 2 billion in demand and you want to lend 2 billion, and demand goes to 3 billion, you're not necessarily going to lend more, again, because there are limits. You just can't lend whatever you want or whatever you can. It's more likely to affect the price, and price with a loan is interest rates. So demand goes up, most likely rates will go up.
So would let's say parent companies' policies be superseded by the demand, or vice versa? Would the demand supersede parent companies' policies?
No, if demand is already at the level where it meets supply and demand goes up, again, every organization is different, but it's unlikely that banks will increase how much they lend, unless they have an intent to. You know, the survey is asking banks, what do you think will happen? So a bank may have a limit of 5 billion, but they only think they're going to be able to lend 4. But if demand goes up, they will lend more. But if it goes up to 6, they're unlikely to.
Right.
Again, above 5, it's more likely to affect the rates. And, you know, one bank isn't going to affect the rates, but the banks as a whole, the banking industry will affect the rates.
So speaking of demand, as a in general, I I thought it's germane to bring this up um, as as last issue that we would like to talk to the members about, and it's the risk in the commercial real estate market. There are news stories clamoring around commercial real estate market, which in a nutshell describes a situation where commercial real estate borrowers are faced with a higher interest rates to refinance, while the occupancy rates have declined due to changes in the work pattern, meaning increase in remote work. Do you think, Paul, there really is a trend forming, or will it just end up as a whisper or clamor and disappear as such?
You know, my opinion is that it's a long-term problem for investors in commercial real estate. The higher interest rates will eventually go down, and the market certainly interpreted Chair Powell's comments yesterday that there's going to be rate cuts next year. I think the expectation is there'll be 3. So they'll go down, and that will help both the bank lenders and the actual investors. I don't think that they're going to go as low as what we had for this past decade, but they'll go down. But apart from rates, there's an overall decline in demand from the lockdown, and that seems to be permanent. Now, no one like the commercial real estate certainly doesn't like that. The politicians generally don't like that. Large cities don't like that. But employers have discovered that work can get done without people in the office. 5 years ago, you and I and it would be somewhere giving this presentation in person. Apart from that, employees decided that they can get their work done and they don't really want to commute and they don't want to spend time commuting. So there's a large portion of the employees who don't really want to be in the office. And that's going to, again, in my opinion, affect the long-term commercial demand. We're in New York. I think a lot of people who joined us are in New York. And certainly Mayor Adams is pushing the conversion of these commercial buildings to residential to also to help with the housing crisis. But that's not a quick change. That's zoning changes. I live downtown New York, and after 9/11, many, probably most of the office buildings did convert to residential. But the buildings in Midtown, which are a lot of glass structures, newer, more modern, probably aren't as compatible to conversion to residential. So it's something that maybe happens in the long term, but the zoning laws and the cost, the overall cost of this probably doesn't get it done quickly.
So it's wait and see for now, I suppose. There's a question that came in.
Oh, yeah. The question is, do the results of this survey inform supervisory practices? I don't know if they do directly. The people at the staff at the Fed that do the analysis are separate from the supervisory personnel. But I would think if the survey gave an extreme example of a decline or an increase in anticipated lending to a certain segment, the supervisors probably read these things and might look more closely at banks that are large in those specific segments. But I don't think they directly affect the supervisory regulations or rules.
That's all we have for you today. If you'd like to share your thoughts with us on these questions, please let us know. We'll be happy to respond. And again, thank you for attending this webinar, and
And I just have a final comment.
Sure.
Some people may think, well, is this enough? I mean, is it enough a quarterly survey? Is it enough that it's a survey? It's not asking for real numbers, it's anticipated expectations. And the Fed does get weekly actual lending data, and they do publish that as something called their FRED database. So the survey, the benefits of the survey, it's forward-looking. And when the Fed does their analysis, they're looking at a dozen different things. They're looking at bank earning calls. They're looking at private conversations with bank CEOs. They're looking at these weekly actual lending. They're looking at this survey. They're looking at trends in the market. So, and my understanding is that they expect these things to be broadly consistent with each other. And if one, whether it's the survey or anything else, is inconsistent with the other, they look at that more closely. See, do we have any other questions? No. Well, I echo
Just
my colleague.
just came in.
Oh, okay. Oh. Question was, thank you, very interesting. Well, we appreciate that. And I echo my colleagues' comments. Thank you for attending. If anything pops up tomorrow or next week, feel free to get in contact with us. And everyone, have a happy holiday.
Yes. Happy holidays and goodbye.